Ever wondered how futures markets work? Well, let's break it down. Futures markets are fascinating platforms where people trade futures. But what are futures? They are financial contracts, but not your run-of-the-mill agreements. These contracts obligate the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and price. Imagine you're a farmer planning to sell your wheat crop 6 months from now. By engaging in a futures contract, you can agree upon a price today, reducing the uncertainty of future market prices. Similarly, a bread factory might want to buy wheat in 6 months but is worried about potential price hikes. They could enter a futures contract to lock in a price now, so when the time comes they know exactly what they're paying. In the world of finance, futures markets provide a platform for such transactions, managing risk and creating price stability. Ready to dive deeper into the realm of futures trading? Buckle up. Now, what exactly forms the structure of these futures markets? To answer that, we must delve into the 3 main components that make up futures markets. These are the futures contracts, the market participants, and the futures exchanges. Let's start with futures contracts. These are legally binding agreements to buy or sell a particular commodity or financial instrument at a predetermined price at a specified time in the future. They are standardized in terms of quality, quantity, delivery time, and location for each commodity to facilitate trading on a futures exchange. The buyer of a futures contract is taking on the obligation to buy and receive the underlying asset when the futures contract expires. The seller, on the other hand, is obliged to provide the underlying asset at the expiry of the contract. Next, we have the market participants. These are mainly divided into 2 categories: hedgers and speculators. Hedgers use futures to reduce or manage the risk associated with the price of an asset. For instance, a farmer might use futures to lock in a certain price for his crop, providing some assurance against fluctuating prices. Speculators, on the other hand, are essentially risk takers. They aim to profit from the markets by betting on the direction in which prices will move. Lastly, we have the futures exchanges. These are centralized marketplaces where futures contracts are traded. Exchanges provide a transparent, regulated environment for market participants to trade futures contracts. They ensure that trading occurs in an orderly manner and that the integrity of the market is maintained. These 3 elements, the futures contracts, the market participants, and the futures exchanges, all interact to facilitate futures trading. The exchanges provide the platform, the contracts provide the rules, and the participants provide the action. So that's the basic structure of futures markets. But how does trading occur in these markets? Let's get into the meat of the matter, the types of trades in futures markets. Dive into the world of futures markets and you'll find 2 primary types of trades: hedging and speculating. Each plays a unique and crucial role in the financial ecosystem, serving different objectives and risk appetites. First, let's talk about hedging. Hedgers are the risk-averse participants in the futures market. They're like the cautious chess players, always thinking a few steps ahead and using futures as a strategic move to reduce risk. How so, you ask? Well, by locking in prices today for transactions that will occur in the future, hedgers protect themselves against the uncertainty of price fluctuations. Imagine you're a farmer worried about the price of wheat falling by the time you harvest. By selling a futures contract at today's price, you ensure that you'll still get that price even if the market price drops. Quite a safety net, isn't it? Now, on the flip side, we have the speculators. These are the risk takers, the ones who thrive on the thrill of the game. Speculators aim to profit from price changes. Unlike hedgers, they don't seek to use futures to mitigate risk, but to potentially increase their profits. They buy futures contracts when they predict prices will rise and sell when they forecast to drop. Of course, with higher potential rewards come higher risks. If their predictions are off, speculators can face significant losses, but it's this very risk and reward dynamic that keeps the futures market vibrant and liquid. So, in essence, the futures market is a fascinating arena where hedgers and speculators, the cautious and the daring, come together. They interact, they influence price movements, and they drive the market forward. It's a dance of balance where one's risk is another's opportunity, and both are essential for the market's functioning. And that, folks, is a quick run-through of the types of trades in futures markets. But how do these trades take place? It's time now to understand the trading process in futures markets. To trade in the futures market, the first step is to open an account with a futures broker. This broker will be your gateway to the market, providing you with the necessary trading platform, tools, and customer support. When selecting a broker, consider factors like their reputation, fees, and the quality of their trading platform. Once you've established your account, the next step is to fund it. The amount you'll need to start trading will depend on the broker's requirements and the margin requirements of the futures contracts you wish to trade. Remember, while futures trading can offer substantial rewards, it also comes with significant risks. So it's essential to only use risk capital, money you can afford to lose without affecting your financial well-being. Now, you're ready to place an order. There are several types of orders you can use in futures trading. Market orders, where you buy or sell a contract at the best available price. Limit orders, where you set a maximum or minimum price at which you're willing to buy or sell. And stop orders, which become market orders once a certain price level is reached. The type of order you choose will depend on your trading strategy and risk tolerance. Once your order is executed, you'll have an open position in the market. An open position is an active trade that has not yet been closed. It's important to monitor your open positions regularly and make adjustments as needed based on market conditions. Finally, when you're ready, you can close your position. This is done by placing an order that is the opposite of your initial trade. If you bought a futures contract, you would sell it to close the position. If you sold a contract, you would buy it back. Closing your position allows you to lock in any profits or losses. There you have it, the trading process in a nutshell. Like all financial markets, futures markets come with their own set of benefits and risks. Let's delve into the advantages first. One of the primary benefits of futures trading is the high leverage it offers. This means that traders can control large amounts of commodities or financial instruments with a relatively small amount of capital. Leverage can magnify profits, but it's also a double-edged sword, as it can also amplify losses. Another key benefit is liquidity. Futures markets are typically very liquid, meaning there are many buyers and sellers active in the market. This makes it easier for traders to enter and exit positions, and it also helps to ensure fair pricing. Futures trading also offers the ability to hedge. In other words, traders can use futures contracts to protect themselves against potential price movements in the underlying asset. For example, a farmer might sell futures contracts to lock in a price for their crops, thereby reducing the risk of price fluctuations. Now, let's talk about the risks. One significant risk in futures trading is market volatility. Prices in futures markets can change rapidly and unpredictably, often in response to news events or changes in market sentiment. This can lead to large and sudden losses. Another risk is the potential for significant losses. Because of the high leverage involved in futures trading, losses can quickly exceed the initial investment. This is why it's crucial to use risk management strategies such as stop-loss orders and position sizing to limit potential losses. Lastly, it's worth noting that futures trading requires a good understanding of the markets and a high level of skill and experience. It's not for everyone, and it's certainly not a place to gamble with money you can't afford to lose. So, while futures trading can be profitable, it's essential to understand the risks involved. So, there we have it, a quick guide to the structure and types of trades in futures markets. We've navigated the intricate pathways of these markets, touching on their structure that hinges on contracts bought and sold at futures exchanges. We delved into the types of trades, exploring the fascinating world of long and short trades, each with its unique approach and potential outcome. We also uncovered the trading process, a precise sequence of events that begins with the opening of a futures account and culminates in the settlement of contracts. And let's not forget our discussion on the benefits and risks of futures trading, a balanced view that illuminates the potential for profit and the inherent risk of loss. As we conclude, I urge you to dive deeper, conduct your research, and consult with a financial advisor before stepping into the futures trading arena. Remember, knowledge is power, especially when it comes to navigating the complex world of futures markets. Until next time, stay financially savvy.
Have you ever wondered how prices of goods and services are determined in the market? Well, the answer lies in the intricate world of pricing theories. These theories form the bedrock of economics, shaping the way we buy and sell, and ultimately, how we live our lives. Let's dive in. First off, we have the laws of supply and demand. Simply put, the law of demand states that as the price of a good or service increases, the quantity demanded decreases, and vice versa. The law of supply, on the other hand, proposes that as the price of a product increases, the quantity supplied also increases. It's a delicate dance between price and quantity, a game of tug-of-war, if you will. Now, where these two forces meet, we find the equilibrium price. This is the price at which the quantity demanded by consumers equals the quantity supplied by producers. It's where the dance of supply and demand finds its harmony, creating a balance that benefits both parties. But it's not as simple as it sounds. Market competition is the wild card that can disrupt this balance. In a perfectly competitive market, numerous small firms sell identical products, and no single seller can influence the price. It's determined purely by supply and demand. However, in a monopolistic market, a single firm dominates, and they have the power to set the price. Then there's oligopoly, where a handful of firms dominate the market. They can collude to set high prices or compete with each other, leading to price wars. And let's not forget about monopolistic competition, where many firms sell similar but not identical products. Here, firms have some power to set their prices, allowing for a fascinating interplay of competition and control. So, you see, pricing theories are not just about numbers. They're about understanding the dynamics of the market, the push and pull of supply and demand, and the influence of competition. They're about making sense of the complex web of interactions that dictate the value of the goods and services in our lives. Understanding these fundamentals sets the stage for grasping more complex pricing strategies. Now that we understand the basics, what if we could predict future prices? This question brings us to the fascinating world of predictive strategies. These strategies are key tools economists use to anticipate the trajectory of future prices. But how exactly does this work? Let's dive in. Firstly, predictive strategies are heavily reliant on historical data. Economists meticulously analyze past trends, patterns, and price fluctuations to identify potential future movements. It's like trying to solve a complex puzzle, where each piece is a chunk of data from the past. Secondly, market trends play a crucial role. Economists keep a keen eye on current market dynamics, including demand and supply, consumer behavior, and competitive landscape. They study these trends to predict how they might evolve and influence future prices. Imagine it as reading the waves on a vast economic ocean. Thirdly, other factors are considered too. These might include political events, technological advancements, and even changes in weather patterns, which can all have significant impacts on prices. It's akin to considering the wind direction while sailing. It might not be the only factor, but it can certainly change the course. Now, predictive strategies come with their own sets of benefits and limitations. On the bright side, they offer valuable insights that can guide decision-making, risk management, and strategic planning. They can act as a compass, helping businesses navigate the unpredictable seas of the market. However, it's important to remember that predictive strategies are not infallible. They are based on probabilities, not certainties. The future remains inherently unpredictable, and even the most sophisticated predictive models cannot fully account for sudden shifts or unforeseen events. It's like trying to predict the weather. You can make an educated guess, but you can't be completely sure until the day arrives. In conclusion, predictive strategies offer a glimpse into the potential future of prices. They can't tell us exactly what will happen, but they can provide a sense of direction. Predictive strategies are not crystal balls, but they provide valuable insights for decision-making. One of the most common applications of pricing theories is cost-based pricing. But what does it entail? Let's unpack this concept to understand it better. Cost-based pricing is a strategy that sets the price of a product or service based on the cost of production, including raw materials, labor, and overheads, plus a desired profit margin. It's like baking a cake where you tally up the cost of the ingredients, the time spent baking, and the electricity used, then add a little extra for your effort and profit. This method of pricing is straightforward and easy to understand. It ensures that all costs are covered and a profit is made, which is particularly advantageous for businesses in the early stages. It's also helpful when pricing unique products or services where there's no existing market rate to guide you. However, cost-based pricing isn't without its drawbacks. The most significant disadvantage is that it doesn't take into account the perceived value of the product or service to the customer. For instance, if you're selling a luxury handbag, the value to the customer may be far greater than the cost of the materials and labor involved in its production. If you price based solely on costs, you could be leaving a significant amount of money on the table. Furthermore, cost-based pricing doesn't consider market conditions or competition. If your competitors are selling a similar product at a lower price, customers may choose their product over yours, regardless of your costs. Additionally, it assumes that all units will sell. If some items remain unsold, the profits calculated under the cost-based pricing method will not be accurate, leading to financial discrepancies. In a nutshell, cost-based pricing provides a simple and logical method for setting prices. It's a good starting point, especially for new businesses or unique products. However, it's crucial to remember that it doesn't account for the value perception, market conditions, or competition. Therefore, it's often beneficial to combine cost-based pricing with other pricing strategies to ensure a more comprehensive and effective pricing approach. Cost-based pricing offers simplicity, but it may not always reflect the true value of a product. One of the go-to predictive strategies for economists is trend analysis. But what makes it so popular? Let's dive into that. Trend analysis, at its core, is the study of historical data to identify patterns and predict future price movements. It's like trying to predict the plot of the next episode of your favorite show based on the events of the previous ones. The more episodes you've seen, the more accurately you can guess what's coming next. Similarly, the more historical data you have, the more accurately you can predict future prices. But how does this work? Well, economists look at various factors like price levels, trading volumes, and market sentiment over time. They then identify trends, such as upward or downward movements, and use these to make educated guesses about the future. It's a bit like weather forecasting. You look at the patterns and trends in the weather data, and then make an educated guess about whether it's going to rain tomorrow. However, just like weather forecasting isn't always accurate, trend analysis has its limitations. It assumes that history will repeat itself, which isn't always the case. Remember, the future is influenced by a multitude of factors, many of which can't be quantified or predicted. So while trend analysis can provide valuable insights, it's not a crystal ball. Moreover, trends can sometimes be misleading. For instance, a short-term upward trend could be part of a larger downward trend. So, it's crucial to interpret the trends carefully and in the right context. It's like reading a book. You can't just pick out a sentence and understand the whole story. You need to consider the broader narrative. In conclusion, trend analysis is a powerful tool in the economist's toolkit. It can help predict future price movements based on historical patterns and trends. However, it requires careful interpretation and should not be used as the sole basis for decision-making. It's a guide, not gospel. Trend analysis can be a powerful tool, but it requires careful interpretation and should not be the sole basis for decision-making. Now, how do pricing theories and predictive strategies interact in the real world? Well, let's dive into that. You see, pricing theories essentially form the backbone of predictive strategies. They offer a fundamental framework for understanding and anticipating price movements. For instance, the cost-based pricing theory, which posits that prices are largely determined by production costs plus a profit margin, can inform predictive strategies by providing insights into how changes in production costs might affect future prices. But it doesn't stop there. Demand-based pricing theory, which suggests that prices are set according to consumer demand, can also be used to inform predictive strategies. If you anticipate a surge in demand for a particular product, for example, you can predict that its price will likely increase. Similarly, if you expect demand to wane, you can prepare for a potential price drop. Now here's the catch. No single pricing theory or predictive strategy is foolproof. Each has its limitations and blind spots. That's why it's critical to combine different theories and strategies when trying to forecast future prices. By doing so, you can offset the weaknesses of one approach with the strengths of another, leading to more accurate and robust predictions. For example, you might combine cost-based pricing theory with trend analysis, a predictive strategy that involves studying past price movements to predict future ones. This combination can provide a more comprehensive picture of how prices are likely to evolve, taking into account both production costs and historical price trends. Moreover, the interplay of pricing theories and predictive strategies is not a static process. It's a dynamic, ongoing dance, constantly adjusting and evolving in response to changing market conditions and new information. It requires a keen understanding of economic principles, a good grasp of statistical methods, and a healthy dose of intuition. In the world of economics, pricing theories and predictive strategies go hand in hand, providing valuable tools for navigating the complexities of the market. It's not just about understanding how prices are set or predicting where they're headed. It's about using that knowledge to make informed decisions, seize opportunities, and mitigate risks. And that, my friends, is the art and science of economics. Ever wondered how important risk management and hedging are in financial markets? Well, let's dive right in. Imagine you're a sailor heading out to sea. You wouldn't set sail without a compass or a map, would you? In the vast ocean of financial markets, risk management and hedging are your compass and map. They are the tools that guide investors through the stormy seas of financial uncertainty, helping them navigate safely to their financial goals. Risk management is all about understanding, evaluating, and prioritizing risks. It's like the weather forecast for our sailor, giving a heads up about potential storms and rough seas. With this information, the sailor can prepare and adjust the course to avoid any potential mishaps. Similarly, in financial markets, risk management allows businesses and investors to identify potential risks and take appropriate measures to minimize their impact. Now let's talk about hedging. This is a strategy used to offset potential losses that may be incurred by an investment. It's like our sailor's lifeboat. If the ship encounters a storm and starts sinking, the lifeboat can save the sailor. In the same way, hedging in financial markets can protect investors against unexpected market downturns. It's a way of ensuring your investments against potential future losses. So, why are these two concepts so important? Well, think about our sailor again. Without a compass, a map, a weather forecast, or a lifeboat, the sailor's journey could quickly turn into a disaster. The same applies to financial markets. Without risk management and hedging, investors might face significant losses that could have been avoided. Moreover, these two concepts play a crucial role in maintaining financial stability. They help businesses and investors to manage their financial risks effectively, which in turn contributes to the overall health and stability of the financial markets. In essence, risk management and hedging are not just about avoiding losses. They are about making informed decisions, planning for uncertainties, and staying afloat even when the market conditions are unfavorable. So risk management and hedging are not just buzzwords, they are crucial elements of financial markets. But what exactly is risk management? A question that's been echoing in the minds of many, isn't it? Let's break it down. Risk management at its core is about identifying, assessing, and controlling threats to an organization's capital and earnings. It's like a shield, protecting your hard-earned assets from the unpredictable arrows of adversity. Imagine you're a captain of a ship. You wouldn't set sail without a proper plan, would you? You'd need to know the weather conditions, the state of your ship, the skill level of your crew, and your route. In the same way, risk management is the compass that helps businesses navigate the choppy waters of the market. It's the strategic planning that can help steer clear of potential threats. Now, let's dig a little deeper. The process of risk management involves several crucial steps. First, it's about identifying potential risks. This could be anything from market fluctuations, economic downturns, legal liabilities, to operational failure and more. Next is the assessment. This is where we determine the likelihood and consequence of these risks. We ask, what's the potential damage? And how likely is it to happen? It's like predicting the strength of a storm and its probable path. Following the assessment, we have risk control. This is where we implement strategies to manage these identified risks. It could be avoiding, reducing, sharing, or even accepting the risk. It's like adjusting your sails, changing your course, or even waiting out the storm in a safe harbor. Risk management is an ongoing, evolving process that requires continuous monitoring and updating. It's not a one-time thing, but a constant vigilance to ensure that the business remains resilient amidst the unpredictable tides of the global economy. The key takeaway here is that risk management is not about eliminating risks. That's an impossible task. It's about understanding, managing, and minimizing these risks to ensure the smooth sailing of a business. In essence, risk management is the process of making and carrying out decisions that will minimize the adverse effects of risk on an organization. So let's keep our compasses ready and our shields up as we navigate the vast ocean of finance. Now that we understand risk management, let's move on to hedging. Hedging, in essence, is an insurance policy for your investments. It's a strategy used to offset potential losses that may be incurred by price fluctuations in an asset. Picture this, you're on a seesaw. On one end, you have potential profits, on the other, potential losses. Hedging is the act of balancing that seesaw, making sure you don't hit the ground too hard if things go south. Now, let's break it down a bit further. Say you own 100 shares in a company and you're worried the price might fall. To protect your investment, you could take out a put option. This gives you the right, but not the obligation, to sell your shares at a set price, the strike price, within a certain time frame. If the share price falls below the strike price, you can sell your shares for more than they're worth in the market. That's a win. But what if the share price goes up? Well, that's the beauty of hedging. You'd simply let your put option expire worthless and enjoy the benefits of your shares' increased value. It's all about reducing the potential for financial loss. But remember, hedging isn't about making money, it's about protection. It's like buying insurance for your car. You don't buy insurance hoping to make a profit from a crash, do you? No, you buy it to protect yourself from potential financial harm. Moreover, hedging isn't a one-size-fits-all strategy. It's tailored to the individual investor's risk tolerance, investment goals, and market outlook. It's a tool in the investor's toolkit used to manage risk, just like diversification and asset allocation. In a nutshell, hedging is a technique used to reduce risk and protect against potential financial loss. It's a savvy move for any investor, from Wall Street bigwigs to everyday folks looking to safeguard their hard-earned cash. So, hedging is essentially about reducing the potential for financial loss. Now we know what risk management and hedging are, but how do they relate to each other? Let's picture risk management as the broad umbrella under which various strategies reside. Hedging is one of these strategies. In essence, hedging is a risk management technique used to limit or offset the probability of loss from fluctuations in the prices of commodities, currencies, or securities. So, you see, risk management and hedging are not isolated concepts. Rather, they're interwoven in a way that one supports the other. Think of risk management as the mastermind, the strategist, the one who identifies, assesses, and prioritizes risks. It's like a chess player, constantly scanning the board, evaluating the possible moves, and planning the best course of action. Now imagine hedging as the knight on that chessboard. It's one of the tools in the player's arsenal, used to protect the king, or in our case, the investment, from potential threats. To put it simply, risk management is the plan, and hedging is part of the execution. Risk management provides the framework to identify potential risks, while hedging offers the means to mitigate those risks. Consider this scenario. A company anticipates that the prices of raw materials it needs will rise in the future. The risk management team identifies this potential risk. Then, as a hedging strategy, the company might decide to enter into a futures contract to buy the raw materials at a fixed price. This way, even if the prices soar, the company is protected from the financial impact. So, it's fair to say that hedging acts as the safety net in the high-wire act of financial decisions. It's a tangible way to implement risk management strategies, offering a buffer against financial uncertainties. To sum it up, Risk management and hedging are two sides of the same coin. While risk management focuses on identifying and assessing potential risks, hedging aims to minimize the impact of those risks. In other words, hedging is a practical application of risk management principles. Let's recap what we've learned about risk management and hedging. Over the course of this discussion, we've delved into the intricacies of these two fundamental concepts in the realm of finance. First, we tackled risk management, the process of identifying, assessing, and controlling threats to an organization's capital and earnings. These threats, or risks, could stem from a wide variety of sources, including financial uncertainty, legal liabilities, strategic management errors, accidents, and natural disasters. The goal of risk management is to reduce different risks related to a pre-selected domain to an acceptable threshold by using financial instruments. Next, we ventured into the world of hedging, a strategy designed to offset potential losses that may be incurred by an investment. In essence, hedging involves taking an offsetting position in a related security, such as a futures contract. A futures contract is a legal agreement to buy or sell a particular commodity or asset at a predetermined price at a specified time in the future. We also explored the interrelation of risk management and hedging. These two concepts are not mutually exclusive. Rather, they complement each other in the financial ecosystem. Hedging is essentially a form of risk management, but it's more specific in nature. While risk management can pertain to any potential setback or disaster, hedging is specifically tailored to the risks that financial instruments carry. In the volatile world of finance, the importance of these strategies cannot be overstated. They serve as financial safety nets, minimizing potential losses and ensuring the financial health of organizations and individuals alike. By effectively managing risks and hedging against potential losses, we can navigate the uncertain waters of the financial market with greater confidence and security. And that's a wrap on risk management and hedging. Remember, in the world of finance, managing risk and hedging against potential losses can be the difference between financial success and failure.
Have you ever wondered how to benefit from the passage of time in the stock market? If so, you're not alone. One of the many strategies seasoned traders and investors use is known as a calendar spread. So what exactly is a calendar spread? Well, it's a strategy that involves buying and selling two options of the same type. These options can either be calls or puts, but they must be on the same underlying security. Now here's the twist. While the options are of the same type and on the same security, they have different expiration dates. Let's take a moment to visualize this. Imagine you're holding two cards in your hand. Both cards represent options on the same stock. Let's say, for example, Apple. One card expires in a month, the other in 3 months. You're holding a calendar spread. The beauty of this strategy lies in its potential to benefit from time decay and changes in implied volatility. Time decay, known in the trading world as theta, refers to the reduction in the value of an option as the expiration date approaches. Essentially, as time passes, the option you sold, the one with the shorter expiration date, decreases in value faster than the option you bought, the one with the longer expiration date. This can result in a net profit. As for implied volatility, it's a measure of the amount by which an underlying security is expected to fluctuate within a specific period. Changes in implied volatility can also affect the value of options, thus potentially impacting the profitability of a calendar spread. However, it's important to note that while calendar spreads can offer potential benefits, like any other investment strategy, they also carry risks. Therefore, they should be used as part of a well-diversified portfolio and not as a standalone investment strategy. Now that you have a basic understanding of what a calendar spread is, let's delve into its intricacies. So, how exactly does a calendar spread work? That's a great question. A calendar spread, also known as a horizontal spread, is a strategy that involves buying and selling two options of the same type and strike price, but with different expiration dates. Here's how it works. You sell a near-term option and buy a longer-term option. Essentially, the goal is to profit from the passage of time or a rise in implied volatility. It's like playing a waiting game, where you're betting on the slow and steady rather than the quick and unpredictable. Now you might be wondering, why would I want to do that? Well, there are a couple of reasons. First, if the stock price remains steady until the expiration of the near-term option, you get to keep the premium from selling that option. That's a win. If the implied volatility rises, the price of the longer-term option you bought will increase more than the near-term option you sold. That's another win. But, like with any strategy, there are risks. The greatest risk is a sharp price move in either direction of the underlying stock. If the stock price moves significantly, it could outpace the benefit gained from the passage of time or a rise in implied volatility. And if the stock price moves too far, the strategy could result in a loss. So it's not all sunshine and rainbows. The reward profile, on the other hand, is quite appealing. The potential profit is theoretically unlimited on the upside, and on the downside, it's limited to the initial debit paid to set up the spread. So, there you have it. The mechanics of a calendar spread, a strategy that profits from a rise in implied volatility or a steady stock price until the expiration of the near-term option. It's a delicate balance of risk and reward that requires a good understanding of the underlying dynamics. Understanding the mechanics of calendar spreads is crucial before embarking on more complex strategies. It's like learning to walk before you run. So if you're ready to run, let's dive deeper into the world of complex strategies. Ready to take your trading game to the next level with complex strategies? Let's dive right in. Complex strategies are, as the name suggests, somewhat more intricate and nuanced than simple or basic strategies. They are the tools of the trade for the experienced, for those who are ready to move beyond the simple buying and selling of calls and puts. At the heart of complex strategies is the idea of combining multiple options positions. Yes, you heard it right. Instead of one position, you're looking at 2, 3, or even more simultaneous positions. This might sound daunting, but remember, with greater complexity comes the potential for greater reward. Now, why would anyone want to juggle multiple positions at once? The answer lies in the unique risk-reward profile that these strategies offer. Complex strategies allow you to fine-tune your positions to achieve a very specific risk-reward balance. This is the beauty of complex strategies. They give you the power to sculpt your trading strategy to match your exact risk tolerance and profit expectation. But there's a flip side to this coin. These strategies are not for the faint-hearted. They require a deep understanding of options trading. They demand not just knowledge, but also skill, patience, and above all, experience. This is why they are typically used by seasoned traders. They are the chess grandmasters of the trading world, moving and adjusting their pieces on the board with precision and foresight. So, what kind of complex strategies are we talking about? There's a whole universe out there, from iron condors and straddles to butterfly spreads and calendar spreads. Each has its own unique charm and challenge. Each offers a different way to navigate the ever-changing currents of the market. To sum it up, complex strategies are the next step in your trading journey. They open up a new world of possibilities and potential rewards. They are your ticket to a more nuanced, more sophisticated trading game. Now that you've got a gist of what complex strategies are, let's see how they work. How can one create and manage complex strategies? That's our focus for this segment. Let's dive right in. Complex strategies are not so much complex as they are advanced. They involve the simultaneous use of multiple options contracts. The process of creating a complex strategy starts with understanding the market and the trends. Once you have a clear idea of the direction in which the market is moving, you can then decide on the strategy that best fits your risk tolerance and investment goals. There are different types of complex strategies that traders use. Let's take a look at a few of them. First, we have iron condors. This strategy is used when a trader expects low volatility in the underlying asset. It involves selling an out-of-the-money put and an out-of-the-money call. At the same time, you buy a further out-of-the-money put and call for protection. Next, there are butterfly spreads, which are used when a trader expects the price of the underlying asset to stay within a specific range. This strategy involves buying an out-of-the-money call, selling 2 at-the-money calls, and buying another in-the-money call. Finally, we have straddles, which are used when a trader expects high volatility but is unsure of the direction. This involves buying a call and a put with the same strike price and expiration date. Each of these strategies has a unique risk and reward profile. Iron condors and butterfly spreads limit potential losses but also cap potential gains. On the other hand, straddles can result in unlimited gains but also carry unlimited risk if the market moves significantly in either direction. In the end, creating and managing complex strategies is about understanding the market, knowing your risk tolerance, and choosing the best strategy for your investment goals. Remember, these strategies are not for everyone and should be used with caution. By mastering complex strategies, you can potentially maximize your returns and minimize your risk. So, what have we learned about calendar spreads and complex strategies? Well, we've navigated the intricate world of calendar spreads, delving deep into the mechanism that allows traders to take advantage of the time decay in options. We've understood that a calendar spread is a strategy that involves buying a long-term option and selling a short-term option of the same underlying security with the same strike price. This strategy is a crucial tool for traders who want to capitalize on the nuances of time decay and volatility. We've also discovered how to use calendar spreads to our advantage, especially when we anticipate little to no movement in the underlying security's price in the short term. We've seen how this strategy can provide a steady income stream with its potential for high returns and limited risk. But our journey didn't stop there. We also ventured into the realm of complex strategies. We've learned that these aren't just for the seasoned traders among us, but are accessible and can be beneficial to anyone willing to take the time to understand them. Complex strategies, like the iron condor or the butterfly spread, allow us to make profits in a range of market conditions, offering flexibility and a higher probability of success. We've highlighted the importance of these strategies in navigating the unpredictable waters of the financial markets. They offer a way to mitigate risk, maximize profits, and provide a safety net in volatile times. But as always, understanding these strategies is just the first step. Application and practice are key. It's about taking this knowledge, applying it in the real-world world, and learning from the experience. Remember, knowledge is power. The more you understand about these strategies, the better equipped you'll be to navigate the financial markets. Until next time, happy trading.
Ever wondered how traders minimize risk and maximize profits in the volatile world of finance? Enter futures markets and derivatives. These two are like the secret spices of the financial world. The futures market is a central marketplace, physical or electronic, where buyers and sellers from around the globe meet to negotiate future transactions. They are essentially contracts that bind parties to buy or sell assets at a future date and at a predetermined price. As for derivatives, think of them as contracts whose value is derived from an underlying asset. It could be commodities, currencies, stocks, bonds, you name it. They are the tools that traders and investors use to protect themselves from unexpected market swings or to make a profit from them. From hedging risks to speculating on future price movements, futures markets and derivatives play a crucial role in the financial system. Understanding these financial instruments can provide a wealth of opportunities for both domestic and international trading. Now imagine you're a trader in your home country. You're trading in a domestic futures market. This is a space where you can buy or sell a specific commodity or financial instrument at a predetermined price, but with delivery and payment occurring at a future date. Domestic futures markets and derivatives have some unique characteristics that set them apart from other financial markets. They offer a range of financial instruments that are based on underlying assets such as commodities, equities, and bonds. The main purpose of these markets is to provide a platform for hedging against risks and for price discovery. In a domestic futures market, traders have the advantage of familiarity. They understand the local market dynamics, regulations, and economic indicators better than in foreign markets. This knowledge can provide a competitive edge in trading decisions. Derivatives in these markets, such as futures and options contracts, allow traders to speculate on the future price of an underlying asset without having to own the asset itself. This means that traders can potentially make profits from price movements without a significant upfront investment. However, like all financial markets, domestic futures markets and derivatives carry their share of risks. The primary risk is the uncertainty of future prices. If a trader's predictions are incorrect, they could face significant losses. Additionally, these markets are highly leveraged, meaning that small changes in the price of the underlying asset can lead to large changes in the value of the derivative. Despite these risks, domestic futures markets and derivatives play a crucial role in the financial system. They provide a mechanism for price discovery, allowing prices to reflect current and future supply and demand conditions. They also provide a way for traders and businesses to hedge against potential price changes, reducing the risk of financial loss. In conclusion, domestic futures markets and derivatives have their unique characteristics, which make them a vital part of a country's financial system. Whether you're a seasoned trader or a novice, understanding these markets can provide valuable insights into the complexities of the financial world. But what if you want to venture beyond your borders, into the international arena? Well, international futures markets and derivatives offer a unique and exciting landscape for investors. Much like their domestic counterparts, these instruments allow you to buy or sell an asset at a predetermined price in the future. But they come with a twist. They are influenced by the economic and political conditions of various countries, not just one. These markets are vast and diverse, featuring a wide range of assets from global commodities like oil and gold, to foreign currencies and global equity indices. This diversity allows for greater opportunities for diversification, which can help spread risk and potentially enhance returns. Now, let's talk about how they work. Much like in domestic markets, traders in international futures markets enter into contracts that stipulate the buying or selling of a specific asset at a future date. The price is agreed upon at the time of the contract, providing a level of certainty in an uncertain world. But remember, with great opportunity comes great risk. International futures markets and derivatives are subject to not only market risks, but also currency risks, geopolitical risks, and regulatory risks. For example, changes in foreign exchange rates can significantly impact the value of your investment. Similarly, political instability in a country can affect the price of its commodities. So how do they differ from domestic markets? Well, while domestic markets are influenced by local economic conditions and regulatory frameworks, international markets are subject to a much broader array of influences. This makes them potentially more volatile, but also more rewarding for those who can successfully navigate their complexities. In conclusion, international futures markets and derivatives offer a whole new world of opportunities. They allow you to diversify your portfolio and gain exposure to different economies. But they also come with their own set of challenges. It's a thrilling game of high stakes that requires sound knowledge, keen insight, and a good dose of courage. International futures markets and derivatives offer a whole new world of opportunities, but also come with their own set of challenges. So, domestic or international futures markets and derivatives, which one's for you? Let's dive a bit deeper and compare these two to help you make an informed decision. First, let's talk about domestic futures markets and derivatives. The most notable advantage here is familiarity. If you're trading in your home country, you're likely to have a better understanding of the economic climate, the regulatory environment, and the specific commodities or financial instruments being traded. This familiarity can give you an edge in predicting market trends and making profitable trades. However, domestic markets can sometimes be limiting. They may not offer as wide a range of commodities or financial instruments as international markets. And if your country's economy is small or volatile, the domestic market may not provide the stability and diversity you're looking for. Now let's turn our attention to international futures markets and derivatives. The most obvious benefit here is the opportunity for diversification. By trading in different countries, you can spread your risk across various economies and markets. This can help protect you against downturns in any one market. Moreover, international markets often offer a broader range of commodities and financial instruments. For example, while the US futures market might focus heavily on agricultural commodities like corn and soybeans, the London Metal Exchange offers futures contracts on metals like copper and aluminum. But trading internationally isn't without its challenges. For starters, you'll need to navigate a whole new set of regulations and cultural practices. Currency exchange rates can also impact your profits. And don't forget about the time difference. If you're in New York and trading on the Tokyo Commodity Exchange, you might need to stay up late or get up early to catch the market hours. Let's illustrate these differences with an example. Suppose you're a trader in Australia. You could trade wheat futures on the Australian Securities Exchange, where you're familiar with the market dynamics and regulations. But if you want to diversify and take advantage of the large US wheat market, you could trade wheat futures on the Chicago Board of Trade. However, this would require understanding US regulations and dealing with currency exchange and time difference issues. So, which is better, domestic or international? Well, there's no one-size-fits-all answer. It depends on your risk tolerance, your knowledge of the markets, and your willingness to navigate the complexities of international trading. Some traders might prefer to stick with what they know and trade domestically. Others might see the potential rewards of international trading as worth the added challenges. And some might choose a mix of both, trading domestically for certain commodities and internationally for others. Whether domestic or international, each market and derivative type has its own unique features that can cater to different trading needs and risk appetites. So consider your options carefully and make the choice that's right for you. So we've journeyed through the intricate world of futures markets and derivatives, both at home and abroad. We've looked at the inner workings of these markets, understanding how they operate and how they differ from one another. We've unpacked the complexities of domestic futures markets and derivatives, exploring how they function within our own borders. We delved into the specifics, looking at how these financial tools are used, the risks and rewards they carry, and the role they play in our economy. Then, we ventured out into the international arena, examining how futures markets and derivatives work on a global scale. We uncovered the unique challenges and opportunities that come with trading in these markets, and we've seen how they can offer a world of possibilities for savvy traders. We also took a deep dive into the comparison between domestic and international markets, highlighting their distinct characteristics, the benefits and drawbacks of each, and the factors that traders need to consider when deciding which market to participate in. Throughout our journey, we've emphasized the importance of understanding these financial instruments. They are not merely tools for speculation or risk management, but they are vital components of the global financial system. They facilitate the smooth functioning of our economies, allowing businesses to manage their risks, investors to diversify their portfolios, and markets to maintain their stability. But as we've also pointed out, trading in these markets is not for the faint-hearted. It requires a solid grounding in financial concepts, a keen understanding of market dynamics, and a disciplined approach to risk management. It's not enough to simply jump in and start trading. You need to understand what you're getting into, the risks you're taking on, and the potential rewards you could reap. So what's the key takeaway from our journey? It's simple. Understanding the futures markets and derivatives, both domestic and international, is crucial for successful trading. It's not a guarantee of success, but it's a critical first step on the path to financial prosperity. Remember, knowledge of these markets and derivatives can be your key to unlocking the doors of financial success. So keep learning, keep trading, and keep growing.
Have you ever wondered why futures trading often seems like a steep uphill climb? It's not just you. The world of futures trading can often feel like a labyrinth filled with unpredictable twists and turns. The markets are complex, the risks high, and the rewards, while potentially significant, are never guaranteed. Futures trading is not for the faint of heart. It demands a keen understanding of the financial markets and a knack for predicting trends. It's a high-stakes game where the rules are constantly changing and the outcomes can be as unpredictable as the weather. The complexity of futures markets is one of the biggest challenges traders face. There are countless variables at play, from economic indicators and geopolitical events to market psychology and beyond. These factors can cause dramatic shifts in prices, often when least expected. And then there's the risk. Futures trading is inherently risky. It involves speculating on the future price of commodities, currencies, and financial instruments. If your predictions are off, you could potentially lose more than your initial investment. But perhaps the most daunting challenge is the need for a solid, reliable strategy. In the world of futures trading, a well-thought-out strategy is your compass. It guides your decisions, helps you navigate the choppy waters of the market, and most importantly, it helps you manage risk. Yet, despite these challenges, many traders are drawn to futures trading for its potential for high returns. And this is where advanced technical analysis comes in. It's a tool that can help traders make more informed decisions. It involves studying past market data to identify trends and patterns that can help predict future price movements. So, the question is, how can we turn these challenges into opportunities? The answer lies in advanced technical analysis. It's not a magic bullet, but it can provide valuable insights and help tilt the odds in your favor. Stay tuned as we delve deeper into this fascinating subject in the next scene. Now, what exactly is advanced technical analysis? Well, let's dive right into it. Advanced technical analysis is a financial market strategy that's all about the study of market data. It's like being a detective, using clues such as prices and volumes to predict future trends. You're essentially using past performance to try to foresee the future. Now, you might be wondering, how is this different from basic technical analysis? Great question. The key difference lies in the tools and techniques used. While basic technical analysis might use simple charts and trends, advanced technical analysis goes a step further. It's like comparing a magnifying glass to a microscope. Advanced technical analysis uses complex techniques like Elliott wave theory or Fibonacci retracements. It's about zooming in to understand the finer details of market behavior. Imagine you're a surfer. Basic technical analysis is like looking at the ocean to judge the waves. You see a big wave coming, you paddle faster, but advanced technical analysis, that's like understanding the tides, the wind, the moon phase factors that influence the waves. It's about getting a comprehensive understanding of the entire ocean to make the best decision on when to ride the wave. And here's the thing about advanced technical analysis. It's not just about predicting market trends. It's also about managing risks. It's about knowing when to hold on and when to let go. It's about understanding the market's mood swings, so to speak, and making informed decisions to protect your investments. So, why should you care about advanced technical analysis? Because it gives you a deeper understanding of market dynamics. It's like having a map and compass in the vast and unpredictable world of futures trading. It allows you to navigate the market with more confidence and precision. By mastering advanced technical analysis, you can unlock a whole new level of understanding of the futures market. It's a tool, an approach, a mindset that can help you ride the waves of the futures market with more confidence and skill. So, are you ready to dive deeper? Now, let's delve into the step-by-step process of advanced technical analysis. Step 1. Data collection. The foundation of technical analysis is data. You need a vast array of historical and real-time data on the futures contracts you're interested in. This data includes price points, trading volumes, open interest, and other relevant market information. The more comprehensive and accurate your data, the more reliable your analysis will be. Tools like data feeds and trading platforms can make this step easier, providing you with a wealth of information at your fingertips. Next up, charting. This is where you transform your raw data into visual representations. Charts allow you to see patterns, trends, and anomalies that might be difficult to spot in a spreadsheet of numbers. The type of chart you choose depends on your personal preference and the information you want to highlight. Common chart types include line charts, bar charts, and candlestick charts. Each has its strengths and weaknesses, but all can provide valuable insights. Moving on to step 3, pattern identification. This is where the art of technical analysis comes into play. You're looking for patterns in your charts that suggest future price movements. These patterns could be simple, like a trend line, or more complex, like a head and shoulders pattern. The key here is practice. The more you work with charts, the better you'll get at spotting these patterns. Step 4. Indicator application. Indicators are mathematical calculations based on a futures contract's price, volume, or open interest. They provide additional context to your charts, helping you understand what's driving price movements. There are hundreds of indicators available, each with its own strengths and weaknesses. Some popular ones include the Relative Strength Index, Moving Averages, and Bollinger Bands. It's important to understand how each indicator works and what it can tell you about the market conditions. Finally, we come to interpretation. This is where you bring everything together to make a trading decision. You've collected your data, charted it, identified patterns, and applied indicators. Now, you need to interpret what it all means. Are the patterns and indicators suggesting a bullish or bearish market? How confident are you in this interpretation? What are the potential risks and rewards of acting on this information? These are the questions you need to answer in this final crucial step. Remember, each step is crucial and skipping one could lead to inaccurate conclusions. Advanced technical analysis is a process, a journey of sorts. Each step builds on the last, leading you to a more informed trading decision. It's not always easy, and it requires time, practice, and patience. But the potential rewards make it well worth the effort. To wrap it up, we will summarize the key points of advanced technical analysis. One cannot underscore enough the importance of data collection and charting. It's like the compass guiding a sailor through stormy seas. Without a thorough collection of historical and real-time data, charting becomes a shot in the dark. Remember, charting is more than just plotting points on a graph. It includes various types of charts such as line, bar, and candlestick charts, each providing a unique perspective on price movements. Next, we delve into the realm of pattern identification. This is where the art meets the science in technical analysis. By recognizing recurring patterns, traders can predict potential price trends. These patterns, like head and shoulders, double tops, and flags, are the bread and butter of the technical analyst. They are the footprints left behind by market sentiment, giving us a glimpse into possible future price movements. Then we have the role of indicators, the trusty sidekicks to our pattern heroes. Indicators are statistical calculations that help confirm the patterns we see on our charts. They add an extra layer of confidence to our analysis. We've got momentum indicators like the Relative Strength Index, trend indicators like the Moving Average Convergence Divergence, and many more. Each indicator has its unique purpose, and together they form a formidable team. Lastly, but most crucially, is the role of interpretation. This is where the human touch comes in. Technical analysis isn't a crystal ball. It's a tool, and like any tool, it's only as good as the person using it. It's the trader's job to interpret the data, to understand the story the charts and indicators are telling, and then make informed trading decisions based on this understanding. So there you have it, the key points of advanced technical analysis, a powerful tool to help you navigate the complex world of futures trading. So, are you ready to tackle futures trading with a new perspective? It's time to take a leap and invest in learning advanced technical analysis. This is not just a skill, it's an art that can give you the edge you need to succeed in the competitive world of futures trading. Just think about it. With this powerful tool, you can predict market trends and make informed decisions. Imagine the potential returns. Imagine the satisfaction of watching your strategies succeed. It's not going to be easy, of course. You'll need to put in time and effort to practice and to learn from your mistakes. But the rewards, they're worth it. And remember, you're not alone. There's a whole community of traders out there, just like you, who are using advanced technical analysis to their advantage. Remember, the future of trading is in your hands. Use advanced technical analysis to your advantage and make the most of your trading journey.
Have you ever wondered how the world of trading is transforming with the advent of technology? In the past, trading was a manual process driven by human intuition, experience, and the occasional flip of a coin. Traders would rely on their knowledge, gut feelings, and sometimes a bit of luck to make investment decisions. Now, don't get me wrong, traditional trading has its merits. It allows for flexibility and the ability to react to unexpected market events. It's a craft honed over time, blending art and science in the pursuit of profit. However, like everything else in life, Traditional trading has its weaknesses. It's time-consuming, requires constant attention to market movements, and is susceptible to human emotions. A trader could make impulsive decisions based on fear or greed, leading to potential losses. Enter the era of system and algorithmic trading, where technology is reshaping the landscape. System trading is a method of defining specific trading rules for buying and selling securities based on predefined strategies. The goal? To eliminate emotion from trading and increase consistency. Algorithmic trading, on the other hand, is a step further. It involves the use of complex algorithms to automate trading strategies. These algorithms analyze market data, identify trading opportunities, and execute trades at lightning speed. The beauty of algorithmic trading is its ability to process vast amounts of information far beyond human capacity and execute trades based on that data in a fraction of a second. While both system and algorithmic trading aim to minimize human error and emotion, they differ in their complexity and the level of automation involved. System trading still requires human intervention to execute trades, while algorithmic trading is fully automated, leaving no room for human error. Now, of course, both these methods come with their own set of challenges, including technical glitches and the risk of over-optimization. But there's no denying that they're revolutionizing the trading world, offering efficiency, speed, and precision that was once unimaginable. Now that we've set the stage, let's delve deeper into the world of system and algorithmic trading. System trading, quite the buzzword these days, isn't it? Let's dive in and get a better grasp of what it's all about. System trading, also known as mechanical trading, is a way of defining trade goals, risk controls, and rules that can make investment and trading decisions in a methodical way. It's a framework that allows traders to make consistent decisions regardless of the emotional state they might be in. So, how does it work? System trading makes use of preset rules for making trading decisions. These rules are designed based on historical data and can be tested to ensure they would have been profitable in the past. Once these rules are set, the system can then automatically execute trades based on these rules. This can take a lot of the guesswork and emotion that often comes with traditional trading out of the equation. The benefits of system trading can be quite attractive. For one, it allows for consistency in decision-making. It's not influenced by fear or greed, and it doesn't second-guess itself. Moreover, it allows for backtesting, that is, applying your trading system to historical data to see how it would have performed. This can provide a level of confidence in your system before you start using it with real money. However, it's important to remember that system trading isn't without its challenges. One of the biggest drawbacks is the risk of over-optimization. This is when a system is so finely tuned to past data that it becomes ineffective in the future. It's also worth noting that system trading requires a high level of discipline. The system must be followed exactly, even when it's tough to do so. Lastly, system trading can also be quite complex, requiring a deep understanding of the market and trading strategies. System trading certainly has its perks, but it's not the only game in town. Let's turn our attention to algorithmic trading. Algorithmic trading sounds complex, doesn't it? But it's not as daunting as you might think. Let's dive into the fascinating world of algorithmic trading, where the human touch in trading takes a back seat and machine intelligence takes over. Algorithmic trading, also known as algo trading, is a method of executing orders using automated, pre-programmed trading instructions accounting for variables like time, price, and volume. These algorithms, or algos for short, are designed by quants, who are technically skilled mathematicians and programmers. The algos are then fed into computers, which carry out trades on their behalf with a speed and precision that humans simply can't match. Here's the kicker. Algorithmic trading brings several advantages to the table. It removes the emotional aspect of trading decisions, offering objectivity and discipline. It's also faster, more accurate, and can operate round the clock. Plus, it can scan and monitor live market data across multiple markets, something a human trader would struggle to do. But like any technology, it's not without its challenges. For one, algorithmic trading requires sophisticated infrastructure and technical expertise, which can be expensive. Moreover, if there's an error in the algo, it can result in substantial financial loss. And let's not forget, it's heavily reliant on the stability of the technology it uses. A glitch or a crash could spell disaster. Yet despite these challenges, the use of algorithmic trading has grown exponentially over the past decade. In fact, it's estimated that over 3/4 of all trades on global stock markets are carried out by algos. This is a testament to its effectiveness and the trust that traders place in it. So there you have it, a quick journey through the world of algorithmic trading. It's a world where speed, precision, and objectivity reign supreme, a world where technology is not just an enabler, but the driver. Algorithmic trading is indeed a game changer, but how does it stack up against system trading? System trading and algorithmic trading, two powerful tools in the trader's arsenal, but how do they compare? Well, let's dive right in. First, it's important to understand that both system trading and algorithmic trading are types of automated trading. They both aim to reduce human error and emotional decision-making in trading, a factor that can often lead to losses. System trading, in essence, is a method of defining specific rules and criteria for trade entries and exits. Once these rules are established, they can be automatically executed by a computer, reducing the need for constant human supervision. This method is incredibly useful for traders who want a more hands-off approach, as it allows for a set-it-and-forget-it mentality. However, it does require a thorough understanding of the trading system and its potential pitfalls. On the other hand, algorithmic trading takes this a step further. It uses complex mathematical models and formulas to identify trading opportunities. Algorithmic trading can execute trades at a speed and frequency that is far beyond human capability. It's incredibly efficient, especially in high-frequency trading where every millisecond counts, but it also requires a certain level of expertise in mathematics and programming. So when should you use system trading and when should you use algorithmic trading? Well, it depends on your specific needs and skills. If you're a trader who prefers a hands-off approach and has a good understanding of trading systems, then system trading might be your best bet. On the other hand, if you're a quant with a deep understanding of maths and programming, then algorithmic trading could be your go-to method. But it's not a case of either or. Some traders find a mix of both works best, using system trading for some strategies and algorithmic trading for others. This hybrid approach allows for the flexibility and speed of algorithmic trading, coupled with the simplicity and straightforwardness of system trading. Remember, the key to successful trading is not just about choosing the right method, but also about understanding it thoroughly and implementing it correctly. As we've seen, both system and algorithmic trading have their place in the modern trading landscape. We've journeyed through the world of trading, from traditional methods to the cutting-edge technologies of system and algorithmic trading. As we wrap up, let's revisit some of the key points we've discussed. System trading, as we've learned, is about following a predefined set of rules. These rules, based on price, timing, quantity, or any mathematical model, guide traders to make objective decisions, eliminating the risk of emotional trading. It offers consistency, discipline, and can be back-tested for effectiveness. However, it's not without challenges. The system is only as good as its rules, making it crucial to have a well-designed strategy. On the other hand, algorithmic trading, often hailed as the future of trading, takes system trading to a whole new level. It uses complex algorithms to execute trades at a speed and frequency that is impossible for a human trader. It's efficient, minimizes mistakes, and can capitalize on opportunities in real time. But remember, it's not a magic bullet. The algorithms need to be constantly monitored and updated to adapt to changing market conditions. Both system and algorithmic trading have revolutionized the trading world, making it more accessible, efficient, and potentially profitable. But it's important to remember that while these tools can be incredibly powerful, they are just that, tools. They are not a guarantee of success, and they require a deep understanding of the markets and a sound strategy. So, as we navigate this ever-evolving landscape, it's crucial to keep learning, adapting, and staying ahead of the curve. Embrace the technology, understand its potential and limitations, and use it to your advantage. As technology continues to evolve, so too will the world of trading. It's a thrilling ride, and you are in the driver's seat.